Have you ever wished you could get inside the mind of a market wizard? Well, today's your lucky day. We're going to explore the trading rules of Ed Seykota, one of the most successful traders of our time. Now, before we get started, make sure to hit that like button and subscribe to our channel for more insightful content on trading and investing. Alright, let's kick things off. Seykota isn't exactly a household name, but his trading prowess is legendary. In the 80s, he achieved staggering returns, growing one client's account by over 250,000% in just 16 years. Yep, you read that right. 250,000%. So, what's Seykota's secret? It all comes down to a simple set of trading rules. By following these guidelines, he managed to stay disciplined and level-headed, even during the most turbulent market conditions. So, are you ready to learn from the master? Let's dive into Seykota's 5 trading commandments. Rule number 1. Cut losses early. This one is a classic, but it's so crucial that it bears repeating. As Seykota says, your primary job as a trader is to protect your capital, making money come second. The key here is to cut losses early. Don't wait for the market to turn around. As soon as the trade goes against you, accept the loss and move on. Embrace it, even. Seykota's wisdom. Losing a position is aggravating, but losing your nerve is devastating. Let me give you a real chart example. Imagine you are trading breakouts. The market is trading upwards, and you are following the trend, so you decide to trade this breakout. The market breaks through the resistance, and you enter your trade. But suddenly the market reverses, and you feel stressed. You don't really know what to do, so you move your stop loss because you think the market will return. But what happens next? The market keeps going down. You can keep moving your stop loss for days, and the market will keep going against you. If you don't cut losses early, you can lose your entire trading account in one trade. So when the market goes against you, remember what your friend Seykota says: your primary job as a trader is to protect your capital. Making money comes second. Rule number 2. Ride winners. On the flip side, when you're right, let those profits run. The secret to consistent profitability isn't having a sky-high win rate, it's about making more on your winners than you lose on your losers. Seykota suggests using an end-of-day approach to identify trends and patterns, which can help you stay patient and ride those winners. But most importantly, you need to walk away from your trading screen and give the market room to breathe. Let me give you an example. You spot a trading range and you are waiting for the breakout. Once the breakout happens, you notice that the breakout is strong, and it is a great opportunity to enter the market and ride the new uptrend. You place an entry here, a stop loss, and the target is the next level. What happens is that the market will play on your nerves before going to the targeted level. As you can see here, the market retraced back to retest the resistance that becomes support. To be honest, nobody knows what is going to happen when the market makes this retracement. Will it keep retracing, and then the market will go down? Or will it retrace and then make another move upwards? Nobody knows, not even Seykota himself. But the difference between Seykota and other average traders is that when he enters a trade based on his own rules, he has a stop loss, so he does not care what the market is going to do. He knows his risk, and if the market goes against him, he knows when he will get out. So if the market moves in your favor and then turns a little bit against you, don't get afraid and close your trade. You have to set and forget the trade, because the goal is to ride your winners and close your losers. Rule number 3. Keep bets small. This one is all about risk management. Seykota recommends risking less than 1% of your account on any single trade. That way, even if you hit a losing streak, the fluctuations in your account will be small relative to your net worth. Remember, there are no guarantees in trading. Let me give you an example. Imagine the market is trending down. If you decide to trade a simple breakout to follow the trend, you might enter at this breakout point. But remember, there's no certainty the market will go in your favor. So even if you're confident the market will keep dropping, it's risky to put too much of your account on the line. For instance, risking more than 20% of your account on this trade could wipe out your entire trading capital. Every trade you take can either go your way or against you. By understanding this, you'll limit your risk to less than 1% per trade. And by sticking to the strategy of riding winners and cutting losers, you'll increase your chances of long-term success. But it's not just about the percentage risk. Seykota also advises not to speculate with more than 10% of your liquid net worth. In simpler terms, only trade with money you can afford to lose, not your rent or grocery money. Rule number 4. Follow the rules without question. As traders, we operate in a world without many boundaries. No one tells us when to trade, what to trade, or how much to risk. That's why having a solid set of trading rules is so crucial. If you have a winning trading strategy, whenever you receive a trading signal to enter a trade, don't second-guess yourself. Don't seek validation in Facebook groups or forums. Stick to your own rules and follow them without hesitation. For example, let's say you're trading chart patterns, and you identify a head and shoulders pattern on your chart. One of your rules is to trade the breakout of the neckline. Once the breakout happens, don't doubt yourself. Simply place your entry, your stop loss, and your target. Then, step away from the charts. Go play football or watch Netflix. If you stay glued to your screen, you'll start questioning yourself, second-guessing your decisions. You might wonder if you made the right choice or if you should listen to what others are saying on social media. These doubts will only lead to poor decisions. So, whenever you take a trade, remember what your friend Seykota said. Rule number 5. Know when to break the rules. Wait, didn't we just say to follow the rules without question? Well, yes, but also no. You see, Seykota understood the importance of intuition and gut feel. Sometimes, regardless of what the rules dictate, if something doesn't feel right, it's best to stay on the sidelines. After decades of trading experience, Seykota's intuition became one of his most valuable assets. So while rules are important, he also gave himself the freedom to override them when his instincts told him to. So if you're a beginner trader, don't rush to break the rules initially. Instead, focus on following them diligently. However, with screen time and practice, you'll develop the ability to discern when to adhere to the rules and when to deviate from them. Ed Seykota's trading success is a testament to the power of discipline, risk management, and trusting your instincts. By following his 5 rules, you too can develop the mindset of a market wizard. Of course, finding an approach that fits your personality is key. As Seykota said, traders can't follow rules for long unless they reflect their own trading style. So take some time to internalize these lessons and adapt them to your own unique approach. Who knows, maybe one day someone will be writing about your legendary trading prowess. I hope this video has taught you something new. Don't forget to like and subscribe to the channel for more videos. Thank you for watching. See you soon.